Welcome back. Blackstone making headlines in the private credit arena this morning. The firm says it will fulfill 100% of repurchase requests in its $82 billion BCRED fund. This after investors sought to redeem a record 7.9% of the fund. Now, Blackstone is meeting those requests by increasing the size of a previously announced tender offer to 7% of total shares. It is stepping in alongside some of its employees to offset the remaining 0.9%. This, of course, is question C. Valuations in private credit. Who better to talk to than Blackstone's president and COO, Jon Gray. Thanks for coming downtown.
It is great to be here, David.
Yeah, rough day and overall, as Carl just told our viewers as well in the markets, and Blackstone shares no exception. How do you view the fact that 7.9% of your fund holders, or those representing 7.9%, wanted their money back?
Well, I think it's worthwhile to step back. We created BCRED 6+ years ago with this idea that we could deliver a premium return to individual investors in non-investment grade credit. And we grew it, as you said, to more than 80 billion of assets, 50 billion plus of equity. We've delivered a 50% premium versus leveraged loans, 10% a year, 8% up last year. And when you think about credit quality, the 400 plus borrowers here, they had 10% EBITDA growth last year. We saw cash flow coverage go up from 1.6 to 2.1, part of that because rates have come down. So when we look at this, we feel pretty darn good.
And you should. So my question is, what's going on then? If you can put up numbers like that and have returns like that and at least can provide metrics on your portfolio that look to be fairly secure, why would 7.9% want to leave?
Well, I think it's also worth noting we had another 4% come in, right? So we had $2 billion of inflows. Our institutional clients, interestingly, away from this, continue to allocate significant amounts to private credit. But we've had a ton of noise, as you guys know better than anybody, in the press. This has become a story. It started with Tricolor and First Brands, which were bank-originated credits. There's a constant spin cycle. And so when that's happening, it's not a surprise that investors can get nervous. Financial advisors can say, hey, I want to redeem. And for us, the key is, are we delivering performance? Are we aligned with our shareholders here? And so what we did, we said here, twice in the past, we've gone above the 5% limits. We did it again here. We wanted to deliver to the investors 100% liquidity. And we also wanted more alignment here. We put in money from the firm and individuals. So I think the key is, there's this disjointed environment now between what's happening on the ground with underlying portfolios and what's happening in the news cycle.
Yes.
And ultimately, these things will resolve themselves. It doesn't mean there won't be individual credits that get in trouble. It's non-investment grade credit. It doesn't mean that there's not disruption, which you guys have been talking about. But the underlying low leverage loans here and the performance of those loans, that's what's going to stand the test of time and will continue to outperform liquid credit.
Right. Okay. A lot of that concern, though, came about as a result of the focus on software companies that will be disintermediated by AI, despite the fact that, as you point out, many of them are perfectly capable of paying back their loans right now. The question becomes, well, what about 2 years from now? And why shouldn't I get out now? Which leads me to, it's not a default issue, John, but it could very well be a liquidity question for this group broadly speaking. And isn't that a concern?
Well, let me break it in two parts. So on the software side, what I'd say is I think it's important to understand what's going to happen to these businesses over time. I think Jensen last week talked about how these companies are going to still be part of the infrastructure, that agentic commerce and agentic work with software firms will continue. I think a lot of these companies are systems of record, hold valuable data, are infrastructure. It's very difficult to rip them out. The underlying performance, some will be more vulnerable, but the underlying performance of these companies has been pretty remarkable. In fact, in our BCRED software portfolio, we saw double-digit cash flow growth last year. And so I think that's one part. The second part of this is there's a difference between equity and debt. When you think about the equity side, we've seen a re-rating of these companies from 18 times EBITDA to 13 times.
Right.
Our debt goes up to 6.5 on average. So there's still a very large cushion there.
There's a big cushion,
yes.
but have you taken the appropriate marks? Because that always becomes an issue, and loan to value obviously goes up as you take those marks, given many of the public comps have come down 40 or 50%.
Yeah. Well, what's come down, of course, has been the equity, but most significantly. But I think what's key here, to your point, is have we been good at marking this portfolio? And the answer is absolutely. In fact, if you look at the bottom 5% of our portfolio, it's marked at 76 cents. And you have to remember here, these software loans were made at just 37% loan to value, and the sponsors put up $3 billion of equity. And there are a lot of terrific companies with terrific management teams. Right. So I think we're in this environment. There is a lot of uncertainty, but lowly leveraged loans with great companies, lots of equity, and a sponsor like us who's looking out for shareholders every day, that's a pretty good place to be.
But I wonder if you get penalized, perhaps, and I can say this, I know you probably won't engage much on it, by the underwriting standards of competitors who may not have been quite as meticulous, perhaps, as you have been at Blackstone.
Well, it's hard to comment on what others have done, not only on what they've done underwriting, but how they've managed vehicles. And we've seen some of this in the past. We've seen dispersion of performance. If you go back to BCRED, which you and I spent a lot of time on.
We did.
The outcome for shareholders has been dramatically different. I mean, if you look at liquidity, if you look at performance, BCRED has delivered 65% above the public REIT market. Last year was almost triple at 8%. It's been paying out to shareholders now for the last couple of years. It's done exactly as advertised. And as bad as this is, and as painful as it is to watch the stock go down and all this negative press, ultimately, when we deliver for our underlying shareholders in this space, what we will see is they will be more loyal to Blackstone. If you look at our overall wealth platform for individuals at $300 billion, we have grown consistently. And so BREIT's back in a growth mode. We talked about that yesterday. It came out.
It has inflows. In fact, I do wonder, do you think that some of the RIAs who control this channel for the retail were taking people out of BCRED and putting them in BREIT?
Well, I don't know if that's happening dollar for dollar, but investors, when they get concerned about something, they may pause. I will tell you, interestingly, here in the first quarter, BREIT had its best inflows.
First time since 22, I think.
Positive.
Right?
Best inflows since 22. Our private equity and infrastructure products for individual investors had their best inflows other than when they've had launch quarters. So there's a breadth and diversity to our firm. And I think people tend to forget that, and they say, oh, this thing's bad. They get very nervous. But we've got a great wealth platform. We continue to deliver for our institutional clients. Last year, we raised more than $230 billion.
And they aren't as worried about near-term liquidity and maybe aren't watching the headlines as much and are more familiar with the portfolio. But I do wonder, again, John, if other firms are unable to meet the redemption request that you were able to, and they have to gate again, and we sit here and we talk about it, it's not going to help you either, is it?
No, it's not beneficial in the near term if that happens. But ultimately, again, if these products produce a premium, then investors will stick with these wealth products. And that's what's happened. And I think what people sometimes fail to recognize is they're designed as semi-liquid products. The idea that there are caps are really a feature, not a bug of these products. And so what you're doing is you're trading away a bit of liquidity for higher returns. And that's what's happened. And I think in the fullness of time, we will continue to see that. And by the way, that's the same trade-off institutional investors have made for a long period of time. And that's why they've allocated roughly a third of their assets.
But does retail understand the product then? We had the same conversation around BREIT.
I think the individual investors and financial advisors, I think in most cases do. I mean, if you look at the prospectus for these products, for BCRED, it's got 6 bullet points on the first page and a half talking about this. When you go back to the BREIT experience, the product's been around for 9+ years. For 8 years, you got your money every month. For 1 year, it took roughly 4 months. And in exchange for that, you got 65% higher returns. That's the benefit of the bargain. So I think you have to look at these as semi-liquid products. The measure of their success is not what the flows are in a given month or quarter, but the performance. And when I look out in a period like this, when people are so nervous, what we look out at, are we delivering for Blackstone investors? Have we made great choices around digital infrastructure, India, life sciences, all different forms of private credit done in a really good way? If we do that, then the customers keep allocating capital, we keep growing. We will have near-term ebbs and flows like this, but it's performance, performance, performance. That's what matters.
Can I just ask you about the news of the day and this and the notion of whether a prolonged conflict in the Middle East sort of impairs your strategies, your long-term strategies?
I don't think it impairs anything long-term, but I think, Carl, certainly public markets become more volatile. We've seen the 10-year move up. You'll see less transaction activity. But again, I think you've got to elongate your hold period and what you're looking at. You know, if you went back a year ago, a little less than a year ago, Liberation Day happened and everyone thought, oh, this is going to be a terrible year. If you went back to 2020, when we had COVID, you would have thought that would have been a terrible year. In both cases, by the end of the year, things look pretty different. So
a lot of gut checks in there.
A lot of gut checks. And there are people, some people get stopped out. But if you own things on a long-term basis, you ride through these storms, you actually look at moments like this where there's great opportunity. I can buy a great company at a discounted price. I can buy a great asset. My gut here is this will ultimately get resolved. The U.S. and its allies will emerge victorious. Obviously, our hearts are with all the soldiers and sailors in the region. But I would just say, I think, again, a little bit of a pause. Focus on these longer-term mega trends. And by the way, we've got a strong U.S. economy. We've got falling inflation, which means cost of capital is coming down. We have this huge AI investment boom, and then we'll have an enormous productivity boom. That is actually a pretty bullish dynamic. We're right now facing some near-term headwinds. Yes, disruption's a concern. Certainly, this war near-term's a concern. But again, look at a longer playing field. That's what we focus on.
Let me come back to AI if I can, because you've been using it at Blackstone for quite some time and developing it and spending a lot of time with the technology. You just spoke positively sort of about the prospects for software companies, which have been sort of the key here in terms of the latest fears. What gives you that confidence based on what you've done when you look at these software companies that so many investors are afraid the next iteration of Claude is going to take away half their business?
Well, I'd want to clarify. We've been talking a lot about disruption, and I do think there are software companies that will be disrupted. There are professional services firms. The world's going to look very different for lots of things. What is a billable hour going to look like 3 years from now? What I was commenting on there was in the credit context, being senior made a big difference. And also, not all software companies are created equal. But I do think management teams are going to have to respond. They're going to have to AI their businesses. In some cases, there will be losses. And when you think about what's happening in markets today, I do think there's going to be a pivot towards hard assets. There's going to be a pivot towards some of the AI infrastructure companies. I think that's going to happen. And yes, there will be some software firms that get hurt here. But it's really, are you being thoughtful about this? Are management teams responding? And in the case of credit, are senior in the capital structure?
And so you're not worried about the next quarter and redemptions on any number of funds?
I would say we're going to have to see what happens with these markets. What I will say is we're going to relentlessly focus on delivering for our customers, our alignment. And I would say if we produce a premium for our customers, that's our best protection. Hard to predict what happens in the near term.
Stock's coming off the lows of the morning, John, but I mean, it's down 30% this year. Blackstone itself, last 2 years haven't been much in terms of performance. How much does that, I don't know, how much does that affect your own psychology or those of your employees?
I think we've got a really long-term approach. The key for us, again, is the performance, the confidence our investors have in us, the fact that last year we raised $230+ billion, the fact that our wealth platform, despite all this, continues to have incredible momentum, the fact that we've made really important calls on where the future is, in fact, investing in some of the LLMs themselves, which has worked out very well. I feel terrific because we have the confidence of our customers and we're delivering for them.
All right.
Investors, markets, as you guys know, up and down in the short term.
Although that retail channel can present a lot of difficulty in terms of understanding and the liquidity and what that means. I mean, you're going to keep hammering at it and everybody else will?
Yeah, we're going to keep going. We're going to keep delivering performance, and ultimately that wins. And people are going to focus on how many fans are in the stands. We're going to focus on the scoreboard. If we deliver performance, good things happen, and I feel terrific about where we're heading in that direction.
John, always appreciate your willingness to come in, particularly on tough days, and join us here. Thank you.
Thank you, David. Thank you, Carl.
Jon Gray, President and COO of Blackstone. Sarah, over to you.